Good morning and welcome to Monday Musing. I want to go over an article in the Wall Street Journal. And as a reminder, you also can get things like the Wall Street Journal delivered to your inbox. If you're interested, just let me know and I can send you a link. So, this is talking about what's going on with the economy. And if you have been following the stock market, it took a sharp dip. So, one of the important things that we talk about when we discuss demand and supply are expectations. Expectations can be self fulfilling prophecy. And I've mentioned that before. And that is what is going on with the coronavirus. So, if you look at this article, it says fear of the coronavirus rather than the virus itself is hitting the world's economies. So, it said based on what's happening to health impacts, it's not that big a deal. But epidemics create uncertainty, and the market hates uncertainty. So it says government authorities and individuals often respond by drastically reducing exposure to the shock, amplifying its global economic impact. And so that is what is happening. So it says risks are skewed toward a larger hit because a change in the news flow can lead to increased risk aversion. So, what this means, for example, there's been 3 new outbreaks reported, and one is in Italy. So, it says less travel. So, a typical maybe over response would be, oh my gosh, I'm not going to Italy because they have coronavirus there. As a matter of fact, I'm not going anywhere and I'm not going to buy anything that comes from any of those countries because I just want to minimize my risk. So that would be an overreaction. And you can see how if everyone did that, that would create such a major impact on, for example, the tourism that goes to Italy or imports and exports. So look at the fear factor here. So these are retail sales. And here we're going along, boom, 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 boom. This one is SARS. Boom. It went down by such a sharp amount. Okay. And SARS was the previous virus that came out of China. Similar happened after 9/11. So I'm going to go ahead and scroll down here, and it just says the World Health Organization, which goes by the acronym of WHO, said it's not clear if it can be stopped. It could be contained like any virus. It could be seasonal, just like the flu. So what that's meaning is this may be something that we see every year. And then, of course, we would sort of get used to it, right? So these are the cases here, and you can see there's a gigantic uptake in South Korea. Okay. So global stocks are mixed. And look at this. Here's the Dow Jones. It's going along, and just all of a sudden, boom. This is known as a contagion effect. So one person tends to follow another. One investor tends to follow another. One market leader will do something and others will follow. And this is the kind of result that we get. So this is a 1,000-point drop. This is the 3rd worst drop in history. So it's pretty much of a big deal. And then that also affected the yield on the bond. So this is called an inverted bond curve, which means that yields or returns on short-term bonds are greater than on long-term bonds. And that is an inverted yield curve, and that can signify an upcoming recession. It just means that people are not confident of the future. So these are just some things that tie right back into what we're learning about. So can expectations be a self-fulfilling prophecy? And the answer is yes. If enough people believe that bad things are going to happen, that belief will change their buying and travel habits, and it will basically lead to the very bad thing that they were afraid of happening. So I'd love to hear your comments and your reactions about this. So email me and let me know what you think about this. All right. Have a happy Tuesday.